Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Additional dynamics to consider. I think investment psychology is by far the most important element, followed by risk control, with the least important consideration being the question of where you buy and sell. Tom Basso. This may seem like a strange quote to put in a book that is about when to buy and when to sell, but it is crucial to understand all of the elements that go into successful trading. There is much more to consider than having a good buy and sell system. The key elements that should partner with your buy and sell signals are position sizing and your risk management principles. You must have an equity curve that you can survive. Most of the traders that don't make it quit because they can't overcome the emotional and financial pain of losing money. Here are some of the other dynamics that you must navigate to effectively execute your entry and exit signals and achieve profitability. Are you able to take the signal you were planning to take when it is triggered? Are you able to cut your loss when your stop is initially hit? Can you control your position size on your entry and not trade too big when emotions get the best of you? Can you resist the desire to add to a losing trade because it looks like a better value in price while it is going against you? You must be able to limit your risk exposure to your planned limit and not keep adding positions or leverage when you have reached your limit. What is the frequency of your trade signals? Are you trading enough markets or stocks to have enough diversity for ample trade opportunities and trends? What is the maximum drawdown you are willing to take? What are your targeted annual returns? What is the warning sign that something is wrong with your trading system? How many commissions will you incur monthly and annually with your system? Is there liquidity risk in your market? How much screen time do you need to execute your trades? How will you know that your trading methodology is not for you? Will you take the entry? Entry signals are useless unless you are willing or able to take them. If you are afraid, then your fear may be trying to protect you from losing money. Try trading smaller than you initially planned to see if that eases your mind. Trading is a business. You should feel serious and focused on entries but not stressed out or losing sleep. Those are warning signs that something is wrong. If decreasing your trade size doesn't resolve your uneasiness, you may need to build more faith in your system by doing more backtesting, chart studies, and coming to terms with the risks involved. Taking your buy signal requires faith in yourself and your system, and that takes patience and time. Start small and you can always increase your size as your comfort level and confidence grows. Will you take your stop loss? It is much easier to exit a profit-taking sell signal than a stop-loss sell signal. The stop-loss level must be embraced when the buy signal is taken. Always consider position sizing and how much money will be lost if the stop-loss is hit. Be prepared to accept that if the price can get to your stop-loss level, then you are wrong. Ego is a roadblock of stop-losses. You must be able to trade your plan with discipline to override your ego. Trading too large makes it difficult to take your initial stop loss because it's easier to hope that it will come back than it is to take the big loss now and accept defeat. It is easier to take a small loss than a big loss. Staying on the wrong side of a losing trade is dangerous because eventually you will be on the wrong side of a trend with a large position size, and you could lose it all. Every profitable trader must develop the skill of accepting a loss when they have been proven wrong. Every time that you take your stop loss and your trade bounces back, you may think that you don't need stop losses and you should wait for a reversal. The reason we have stop losses is the same reason we have brakes on our cars or insurance on our homes. We may not always need them, but it is a bad idea to expose ourselves to the risk of ruin by not having that coverage the one time that we need it. Will you position size safely and consistently? You must consistently take your buy signals based on pre-planned position sizing and not out of desperation or unfounded hope. One of the biggest pitfalls of new traders is trading too large due to overconfidence. Your position sizing must be consistent as you take your buy signals. Each position size must be inside the range of how much you are willing to risk on any one trade. You can risk more capital on the best setups based on the risk-reward ratio and probabilities, but that may mean that you risk losing 2% of your capital when you usually risk 1%. It doesn't mean risking half or all of your capital on one big option or futures trade. That is a recipe for eventual ruin. Can you resist adding to a losing trade? Technical traders shouldn't have the same problems as fundamental traders. As a stock drops lower and lower, it looks like a better value for an investor, but it looks like a downtrend to a trader. All it takes are a few times when a trader finds themselves on the wrong side of a strong trend, adds to the losing trade, and finds themselves in the middle of financial and emotional ruin. A trader should trade small when losing and avoid amplifying their losses. Will you limit your risk exposure? Risking a 1% loss on any one trade is a great way to begin your risk management planning, but you also must consider how many trades you have at any one time, as well as their correlations to each other. How many entry signals can you take before you can't add any more risk? When should you stop taking new entry signals? Will you only expose your trading capital to 3 trades at any one time? Will you limit your total risk exposure to 3 at a time if the trades are correlated positions, like 3 tech stocks? Would you expand to 5 total positions if they are not closely correlated, like trades in oil, gold, the US dollar, the S&P 500, and a tech stock? You amplify your risk when you have multiple positions in the same sector or all in stocks. You can diversify your risk if you are in different markets like bonds, metals, energy, currencies, and agricultural commodities that generally don't move in the same direction at the same time. Study your markets and decide on the appropriate risk based on current correlations. Understand that correlations can change over time and during different market conditions. How many trade signals will your system give you in your time frame? The quantity of your trade signals will be as important as the quality of your signals. You may find a great buy signal only to discover that your signal only triggers once or twice a year. 2 trades a year doesn't work for most traders. On the other side, a day trader may have too active of a signal that can cause 10 losses and 20 commissions to get in and out of trades in one day. That won't work well, either. A trader has to understand how many times a signal will trigger on average in their time frame on their watch list, and calculate the potential losses that could be caused during a losing streak while taking into account their commission costs. If you want a 30% annual return, you may only need 60 trades a year with a 50% win rate if your winners created 2% returns, and your losers only amounted to a 1% loss on your total trading capital. 30 wins that create a 60% return, minus 30 losing trades that create 30% in losses may be all you need. This is a basic example, but it demonstrates the big picture of trading frequency. The majority of traders have higher odds of profitability the less they trade. The more you trade, the more commission costs and bid-ask spreads you have working against you. Do you trade enough markets for buy signal opportunities? If you are trading trends, then you need to be trading enough markets to give yourself the potential of capturing those trends. Systematic trend following systems only work because they are trading diversified futures across all markets: metal, agricultural commodities, energy, bonds, equities, interest rates, currencies, etc. They limit their risk through diversification with small positions for each signal entry, and profit by capturing the trend in whatever market that has won. Trend following doesn't work as well, if at all, when trading only one or few markets. The same thing is true for momentum stock strategies. You need a list of at least 10 to 15 stocks if you are looking to buy the ones that break out and trend. You need to own the right one, but you have to watch enough so you don't miss that right one. For systematic trading to be successful, you need diversification of opportunities to get the buy signals you are looking for. How much money can you handle losing? What percentage of your trading capital are you willing to lose? If you start with $100,000, can you handle getting down to $90,000? Will you quit trading if you end up with only $80,000? It is crucial to make these decisions before you dive into real-time trading. You need to know when you should get out and avoid your maximum loss level. Trade small enough so you never get near your breaking point. Many new traders miss this simple principle because they see the prize but not the danger. It is much easier to keep the money you have than to lose it and try to get it back. Each buy signal is an opportunity to both make money and lose money. How much money do you intend to make trading? Your goal for returns will correlate closely with your potential for losses. Typically, the bigger the return, the greater the drawdown in capital to achieve those returns due to the increased risk. If you want to try for a 50% annual return, you will increase your potential for a 50% drawdown in that attempt. Great traders have average returns of about 20% a year, with drawdowns staying under 10%. Don't fall for promises of easy and quick millions by penny stock pushers or other trading scams. The odds are much greater that you lose all your money. Understand your goal for returns first, then work on a system that has the potential to create those returns. How will you know something is wrong with your trading? If you have more than 10 losses in a row early on, if your heart is pounding on entry and you stay stressed out while holding a position, or you watch every single price tick and you are not a day trader, something isn't right with your methods. Trading isn't an extreme sport. You should be conducting business calmly, using buy signals and sell signals without drama or consternation. The best money managers and traders I know have no emotion because each trade is just one of the next 100. Celebrating a winning trade like you just won the Super Bowl or falling into depression over a losing trade are warning signs that you are overly invested. Excessive losses in a row may mean that your stop losses are too tight, or you are having trouble being patient enough because it is outside your comfort zone. How much will your buy and sell signals cost you in commissions? An often overlooked cost of doing business as a trader is commission costs. If you are a day trader, then you need to calculate your potential round-trip commission costs for entering and exiting each trade over a day, weeks, and months. For example, if a day trader makes 3 trades a day, it will cost $7 on each entry, then $7 on each exit. So $42 a day to execute day trades. That is $210 a week for 5 days, $840 a month for 4 weeks, and $10,920 a year. Commission costs have to be considered in the equation of being a profitable trader. Is there liquidity risk in your market? Before you take a buy signal on a penny stock or stock options, you must make sure the bid-ask spread is tight enough to justify the trade. Traders that buy liquid OTC stocks, pink sheet stocks, or penny stocks, whatever you want to call them, can lose money instantly when getting in them if they are low volume, and you buy at the ask price and the bid is lower. Also, you can try to sell them only to find that there are no buyers. This forces you to wait and take a lower price than the bid while they try to find a buyer to purchase your penny stock. My advice is to avoid penny stocks due to the liquidity risk. Even stock options on major stocks can have slippage on out-of-the-money options due to a lack of liquidity at that price. A $1 gap between the bid-ask spread on an option contract will cost you $100 to get in, and then $100 to get back out. The farther options go away from at-the-money strike prices, the wider the spread gets as liquidity dries up. Only trade options in the front month and close to at-the-money in major stocks to avoid the large losses in the bid-ask spread. How much screen time do you need to execute your trades? Your type of trade signals will dictate how much time you spend in front of the computer each day. There are many trend-following systems that only require you to take your signals at the market open or at the end of the day. There are also trend-following strategies with trade signals and portfolio changes that only happen at the end of the week, or even the end of the month. Many stock investment portfolios only make moves to redistribute their portfolio allocations once a quarter. Warren Buffett may hold a stock for decades. On the other hand, a day trader may need to look at the quote screen all day waiting for his signal. Other day traders may only trade the first and last hour of the markets. Swing traders and position traders may trade once every few days or weeks. Some futures traders trade overnight as their market is open. The important thing is to create signals that you are able to take with your current life commitments. Few people can day trade or focus closely enough on the open and close due to other commitments on their time. Find the right screen time that allows you take your singles, or use automatic buy stops and stop losses if needed. Warning signs that something is wrong. Big losses, 10 consecutive losses, an inability to take your entries or exits, and excessive stress or emotions will tell you that something is wrong with your trading system. Revisit your position sizing, total risk exposure, time frame, stop losses, and the faith you have in yourself and your system. Usually the issues come down to trading too big and or having too tight of a stop loss. How will you know that your trading methodology is not for you? To be successful over the long term, your trading has to fit your personality. Some traders love day trading and the pace of constantly monitoring quotes. Others hate day trading and it bores them or stresses them out. Some love to pick stocks and carry focused position sizes for weeks and months. To be good at trading, you have to love what you do. Find a methodology you are passionate about, and one that you are willing to devote the time and energy necessary to making it a winning system.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.